you have $0 saved. Not because you are irresponsible, not because you do not earn enough, because nobody ever showed you the actual sequence. They told you to save money. They never told you what saving money is actually building toward, or how the structure works at each level, or what changes when the numbers get large enough that the machine starts running without you. This is the sequence, from 0 to 1 million and past it. Every level, every decision, every shift in thinking that has to happen before the next level becomes accessible. The first number is not 0. The first number is $1,000. $1,000 sitting in a separate account that you do not touch under any circumstances except a genuine emergency. Not a sale, not a trip, not a situation that feels urgent but is actually just inconvenient. A real emergency. Medical, job loss, car failure that prevents you from working. The $1,000 buffer is not savings in the wealth-building sense. It is a circuit breaker. Without it, every unexpected expense goes directly onto a credit card, and the interest on that card quietly destroys every dollar you try to save anywhere else simultaneously. The buffer comes first. Everything else comes after the buffer exists. You build the buffer on $200 a month. It takes 5 months. During those 5 months, you do not invest. You do not open a brokerage account. You do not think about index funds or compound interest or any of the concepts that feel more exciting than parking money in a savings account. You build the buffer. It is not glamorous. It is not interesting. It is the foundation that every level above it sits on, and without it, the structure collapses the first time something unexpected happens, which it always does and always will. The buffer exists. Now the thinking changes. You open a high-yield savings account if you have not already. The difference between a standard savings account paying 0.001% annually and a high-yield account paying 4.5% annually on a $5,000 balance is $224 a year. That is not life-changing money, but it is the first evidence that where you keep your money matters as much as how much of it you keep. You are beginning to learn that every dollar has an address, and the address determines what the dollar does while it sits there. Most people never examine their dollars' addresses. They leave money in accounts paying fractions of a percent, while the bank lends that same money out at 7% mortgage rates and 24% credit card rates. You stop doing that the moment you understand it. Your emergency fund grows to 3 months of expenses, then 6. This takes time, and it should. You are not rushing past this level because you understand what it is doing for you structurally. 6 months of expenses in a high-yield savings account means that a job loss, a health crisis, or a major unexpected cost does not require you to liquidate investments, take on debt, or make financial decisions from a position of panic. Panic is the most expensive emotional state in personal finance. Every decision made from panic costs more than the same decision made from stability. The 6-month buffer buys you stability. Stability is worth more than the interest rate differential between the savings account and the investment account you are impatient to fund. The debt question has to be answered honestly at this stage. If you are carrying high-interest debt, credit cards above 15%, personal loans above 10%, any balance where the interest rate exceeds the reasonable expected return on an investment, that debt is the highest return investment available to you right now. Paying off a credit card charging 22% interest is a guaranteed 22% return on that capital. No index fund offers a guaranteed 22% return. No trading strategy offers it reliably. The math is not complicated. High-interest debt gets eliminated before serious wealth building begins because carrying it while investing elsewhere is paying 22% on one side of your balance sheet while earning 10% on the other. The net is negative 12%. You are moving backward while feeling like you are moving forward. The debt is cleared. The buffer is funded. You open a brokerage account. The first investment is not a stock you heard about. It is not a sector ETF based on a trend you read about. It is a broad market index fund tracking the S&P 500 or the total stock market. The index fund is not the exciting choice. It is the correct choice. At this stage, and for most people at every stage, after this one too. The S&P 500 has returned an average of 10.5% annually over the past 8 decades, including every crash, every recession, every crisis, and every recovery. You are not trying to beat that number. You are trying to capture it fully and consistently over the longest possible time horizon. You automate the investment. $300 a month leaves your checking account on the same day your paycheck arrives. It moves before you can spend it. Automation is not a convenience feature. It is a behavioral architecture decision. The human brain is not designed to make consistent long-term financial decisions in the presence of short-term spending temptations. Automation removes the decision entirely. The money moves before the temptation has a chance to form an argument. Every month, the investment happens whether you feel financially confident or financially anxious or financially indifferent. The consistency is the entire point. You turn on automatic dividend reinvestment. Every dividend your index fund pays out buys more shares of the same fund immediately without you doing anything. This is compounding made mechanical. The dividends buy shares. Those shares pay dividends. Those dividends buy more shares. The cycle runs continuously and invisibly, and the effect over a decade is significant enough that the shares purchased through reinvested dividends represent a meaningful portion of your total account value. You set this up once. You never need to touch it again. The market drops 18%. Your $8,000 account becomes $6,560 on paper overnight. You feel something between nausea and the urge to do something. You do nothing. You add your regular $300 that month and you buy shares at prices 18% lower than they were the month before. You are not celebrating the drop. You are not panicking about it. You are executing the system you designed during a calm month when emotions were not involved in the decision-making. The system says invest monthly, regardless of market conditions. You follow the system. The market recovers. It always has. The shares you bought at the bottom are now worth more than the shares you bought before the drop. The drop was not a crisis. It was a discount. Your account reaches $25,000. The number feels real in a way that the earlier numbers did not. At $25,000, you begin to feel the weight of the decision you made years earlier to automate and not touch it. You understand now that the account did not reach $25,000 because of any single brilliant decision. It reached $25,000 because of the absence of bad decisions repeated consistently over time. You did not sell during the drop. You did not redirect the investment towards something more exciting. You did not take money out for things that felt important at the time and would feel irrelevant now. The $25,000 is the accumulated result of dozens of non-decisions, of choosing to do nothing when doing something felt more satisfying. The Roth IRA enters the picture at this stage if it has not already. The Roth IRA is a retirement account that allows your investments to grow completely tax-free. You contribute after tax dollars now, and you pay zero tax on the gains ever. Not deferred, free. On a $200,000 account that grew from $30,000 over 25 years, the tax savings compared to a standard taxable brokerage account can exceed $50,000 depending on your tax situation. You max it out every year, $7,000 annually as of current contribution limits. You treat this contribution as a fixed expense that comes out before anything discretionary is considered. It is not optional. It is infrastructure. Your employer offers a 401k with a match. If your employer matches 4% of your salary and you contribute less than 4%, you are leaving free money on the table in the most literal sense that phrase can be used. The match is an immediate 100% return on the matched portion of your contribution. No investment in any market offers an immediate 100% return with zero risk. You contribute exactly enough to capture the full match on the first day you are eligible, not eventually, not when the budget feels more comfortable, on the first day. The match is part of your compensation. Failing to capture it is the same as refusing part of your salary. Expense ratios are the cost of owning a fund. A fund with a 1% expense ratio charges you 1% of your total investment annually as a management fee. On a $100,000 account, that is $1,000 a year. On a $500,000 account, it is $5,000 a year. Over 30 years, a 1% expense ratio on a growing account does not cost you $30,000. It costs you $180,000 in lost compounding because every dollar paid in fees is a dollar that stops compounding from that point forward. Index funds from providers like Vanguard, Fidelity, and Schwab offer expense ratios as low as 0.03%. The difference between 1% and 0.03% on a long-term portfolio is not a rounding error. It is a retirement. You switch to the lowest cost options available, and you never look back. Your net worth crosses $100,000. The first 100,000 is the hardest, not because the savings rate changes or the strategy becomes more complex, because the compounding has not yet reached the velocity at which it becomes visible in a way that feels motivating. The gap between $10,000 and $20,000 required the same percentage growth as the gap between $100,000 and $200,000, but the dollar amount is 10 times larger. The machine is the same. The output is dramatically different. After $100,000, the compounding begins to show up in monthly statements as numbers that feel meaningful in absolute dollar terms. The interest and gains in a single month start to approach and then exceed your monthly contribution. The machine is beginning to outrun your manual input. Your net worth reaches $250,000. You rebalance your portfolio quarterly. Rebalancing means returning your portfolio to its target allocation after market movements have shifted the percentages. If your target is 80% equities and 20% bonds, and equities have grown to represent 87% of your portfolio, you sell some equities and buy bonds to return to 80 and 20. This is the mechanical version of buying low and selling high. You are trimming the asset class that has grown expensive relative to your target and adding to the asset class that has become relatively cheaper. You do this on a schedule, not based on market predictions. The $400,000 level changes the conversation around tax efficiency. At this level, the tax drag on your investment returns in a taxable account becomes significant enough to warrant specific structural attention. Municipal bonds, which pay interest exempt from federal income tax, become relevant for the portion of your portfolio held outside tax-advantaged accounts. Asset location, meaning which investments you hold inside your Roth IRA versus your 401k versus your taxable account, becomes a decision worth optimizing carefully. The highest growth assets belong inside the Roth, where gains are never taxed. The highest income-generating assets belong inside the 401k, where income is tax-deferred. The most tax-efficient assets belong in the taxable account. This is not complexity for its own sake. It is structure that saves real money in real dollar amounts every single year. You cross $1 million. You check the number on a Tuesday morning. You do not celebrate. You open the spreadsheet and recalculate. The number is real, but what it represents is not a destination. It is a threshold. Above $1 million, the compounding operates at a scale where the annual returns on the portfolio exceed most annual salaries. A 10% return on $1 million is $100,000. Your money is now earning more than most people earn from working. You did not reach this point by earning more than everyone else. You reached it by making the same correct decisions consistently over a long enough period that the compounding had room to do what compounding does when you leave it alone. The machine does not need you to watch it anymore. It has not needed you to watch it for years. You built it correctly at the beginning. You maintained it through every market cycle. You did not interfere when interference felt urgent. You did not extract when extraction felt justified. You let the mechanism run. And the mechanism ran. Exactly as the math said it would from the first month, you understood what you were actually building. Somewhere right now, a person is looking at their bank account with $0 in savings and thinking the distance between where they are and $1 million is so large that the starting point does not matter. They are wrong. The starting point is the only thing that matters, because the starting point is where the mechanism gets switched on. And once the mechanism is running correctly, it does not stop. It does not rest. It does not need encouragement or attention or belief. It compounds, silently, continuously, exactly as designed. The only question that has ever mattered is when you decide to switch it on.